All right, welcome to the first of its kind, world-changing manufacturers network. Lisa Ryan has her ears to the ground and her heart in the game. Get ongoing education and new connections right here with Lisa and the Manufacturers Network. Buckle your seat, listen, and spread the word. Here's Lisa.
Hey, it's Lisa Ryan. Welcome to the Manufacturers Network podcast. Our guest today is Patrick Stroth. Patrick is the National Practice Leader for Mergers and Acquisitions for the Liberty Company Insurance Brokers, a network of professionals based throughout the United States. From his base in Silicon Valley, Patrick helps owners and founders of lower middle market companies secure a clean exit when selling their companies. So, Patrick, welcome to the show.
Lisa, thanks for having me. I'm looking forward to talking to you today.
So share with us a little bit about your background and what led you to doing what you do in this industry.
Thanks a lot. I'm a native San Franciscan. Most of us that are from San Francisco, it's an obligation to tell you that we're from San Francisco, although now I just moved a little bit south to get a little bit more sunshine here in Silicon Valley. I'm a lifelong insurance professional. I'm an independent broker. And a few years ago, I got introduced to insuring mergers and acquisitions transactions. And I got to tell you, I'm an insurance geek, but I consider mergers and acquisitions the most exciting event in all of business. Now, there are some people in Silicon Valley, you think about, well, what about an IPO? Isn't that a bigger deal? No, an IPO is like being drafted in the first round of the NFL draft, okay? Really exciting, but you haven't done anything yet. There is nothing in business that is more life-changing than owners and founders at the end of their career transitioning out and having a liquidity event that could be not only life-changing, but generational. And these are very treacherous, stressful, exciting times. And if with our services, we can help those owners and founders who are my heroes transition over in a way that's smoother, faster, and happier, who wouldn't want to be in that kind of business? And so we've been doing this now in this practice for mergers and acquisitions insurance probably for the last 7 years. And what I want to do is come speak out about just opportunities that are happening with owners and founders of manufacturing companies, which when you're from Silicon Valley, you got a completely different view of what manufacturing is. So I'm excited to talk to you about opportunities out there for the owners and founders here throughout the whole U.S. in manufacturing.
Okay. So what exactly are representations and warranties, and why should manufacturing business owners be concerned about them when selling their company?
Thanks. That's a great question. I'll step back a little bit because we're talking about the transition that owners and founders have. You get to a certain age, and we have probably about 125,000 manufacturing companies in the U.S., according to Forbes, that are owned and operated by baby boomers. They're not going to be doing this forever. And so they're looking forward to the next chapter. And unlike 20, 30 years ago, it was most common for owners of companies to just pass it on to family members or their kids. I remember you could have Smith Manufacturing would then become Smith and Son to Smith and Family or something like that. That doesn't happen anymore. And owners and founders are looking for ways to exit where they can sell their business to maybe another company or to a financial buyer like a private equity company and go ahead and transition out. Now, one of the things about selling a company is that it's not as simple as just going ahead and handing over the keys and getting a check. There's a long process that goes on. And part of the process, if you're selling a company, you're going to be having to put out a lot of disclosures to the prospective buyers. Things like, here are our financial statements, here are our bank accounts, here are some material contracts from customers to show you the customer contracts, supplier contracts, confirming that, hey, we've never been sued, or if we did have some suit or some tax issue 5 years ago, those are done, they're gone. Okay, those are disclosures called reps and warranties. The seller prepares those reps, they send it over to the buyer. The buyer, based upon a number of criteria the buyer has, including looking at all those reps and verifying they're accurate, will make decision on not only whether or not to purchase a company, but at what price. Now, the buyer isn't going to take the seller's word for everything. They're going to go ahead and perform what they call due diligence. Okay, so if you have your financial statements, they're going to look at your bank records. If you have intellectual property, they're going to do some research on that. There are a number of things. A lot of times, particularly if you have a huge, big client, they're going to want to talk to that client, make sure that client's going to stay with them when they buy the company. Okay, but in this process, okay, so you've got these reps and warranties, and you've got the buyer that's performing due diligence. But in this world, a buyer isn't going to be able to know everything. And so what they've done is they have built in what's called a money back guarantee in their contract. It's called an indemnification clause. What the indemnification clause essentially says to the seller is, look, all those reps and warranties you gave us, if any of those end up being in any way inaccurate, or out and out wrong or untrue, and those that would be considered a breach of the reps. If those inaccuracies or breaches end up costing us, the buyer, any money, we reserve the right to claw back some or all of the purchase price. Okay, and so just to make sure that we're going to keep a little cash on the side, because if anything does blow up, we want to be able to have some liquid capital that we can just throw at the problem and mitigate the damages. Here's what we're going to do. We are going to withhold a percentage of the purchase price. We're not going to pay you the whole price. We'll give you maybe 90%. And then a year later, provided nothing comes up, you'll get your extra 10%. Now, the challenge for a lot of sellers who aren't used to this is, wait a minute, I answered all your questions. I gave you every document I had. I bared my soul. And you're saying that if something happens that I didn't know about, you can take it away from me? That's not fair, especially if you discover something 6 months after closing that I didn't know about. You can't hold me to that account. To which the buyer and the buyer's attorney is going to say, you know what, we're betting millions of dollars that your memory is perfect and that you told us everything. Sorry, we're not going to do that. And so unfortunately, the sellers have to grit their teeth and live with the fact that the buyer may come at any time years after to say, you know what, this little item here that was nothing, yeah, I'm sorry, it blew up. We need some money back. And so that can be problematic. Now, in the world of mergers and acquisitions with larger deals, the insurance industry came in and they came up with a policy called reps and warranties insurance. And what that does is the insurance industry came in and said to the parties, look, seller, show us the reps. Buyer, show us your diligence. For a couple bucks, if something blows up, buyer, and you lose money, don't go to the seller. You come to us. We'll pay your loss. That developed product has revolutionized M&A. If you see private equity companies use this product all the time, and private equity hates spending money on insurance. They use it on this product because if the buyer suffers a loss because of the breach, the seller got their clean exit. They're gone, but the buyer knows they can go and get all the money they need back from an insurance company. And so it's moved along very well. And it's essentially used about over 90% of M&A transactions today. The one caveat is this. Not every deal is a $100 million purchase price deal. What do you do about deals that are smaller, that are between $1 million and maybe $30 million in purchase price? That rep and warranty product can't come down to those levels. They just need so much underwriting. They require that the target company have audited financials. Most companies don't have their financials audited. So it's a purview largely for publicly traded companies or very large companies. Okay. What do you do in the lower middle market where you can have a concrete company worth $10 million and that owner and founder would very much like to have the protection for their deal? Now there's a product out there. And this is what I wanted to share with the owners and founders out there is that this risk to you can be protected and is available. The name of the program is called Transaction Liability Private Enterprise, TLPE. And what its purpose is to stand in the shoes of the seller to say, look, if the buyer wants to come after you for anything, seller, you tell us about it, we will respond to the buyer. And it will address real key issues for buyers. If their financial statements are inaccurate, if their material contracts with either suppliers or customers end up not being completely accurate, and perhaps a key supplier decides post-closing they want to change the terms of the deal, all of those types of issues can be taken care of by this policy. And what it enables the seller to do in the manufacturing space is you can look to the buyer and say, we have insurance. You no longer have to withhold 10% of the purchase price in an escrow account. The purpose of the escrow account is solely to address breaches of the reps. If we've got a policy that comes down to $1, guess what? You now no longer need that. Now, this enables the parties to really bypass a lot of the real uncomfortable, I would say almost contentious phase of the negotiations. Okay, when you're a manufacturer, your business, you're not as familiar with the process of buying and selling companies. Your buyer has a huge advantage in that space because they've bought dozens, if not in some cases, hundreds of companies. So they know their way around this thing. What's nice is this provides the leverage that sellers need to go ahead and address these concerns of risk. And a lot of people will come and ask us, okay, that all sounds too good to be true, but how much does it cost? When we were talking about the rep and warranty that it was up at the $100 million deals, those are six-figure policies. But again, if you're going to buy a company for $100 million, you're going to expect to spend a lot of money on everything. But when you've got a company that's under 30 million, you're looking at a cost of $15,000 per $1 million in limits. So in the case, again, of a $10 million company, well, if you don't have insurance, you're only getting $9 million at closing. The buyer's going to hold on to that $1 million, that 10%, for about a year, 18 months. Provided nothing happens, you get the money back. Well, we could go ahead and write a $1 or $2 million limit policy. It'd be between 15 and 30 grand. And then the buyer benefits because they get more protection than the escrow. Seller, you get a clean exit. And what's nice about this is when you have the negotiations, a lot of them involve these reps. You know, the seller wants these reps to be as narrow as possible. Okay, we're talking about our taxes. When we pay taxes, do we have to go back 10 years? Why can't we just go back 3 years? Our material contracts, do we have to go through every material contract? Or can we say just the top 4? And the two sides go back and forth on this, which takes up a lot of time, energy, and legal expenses. If you got an insurance policy that covers the reps as is, then you can bypass that. You're not finger pointing, you're not arguing or digging heels in. You just move forward. And then you've got the peace of mind. You got the peace of mind knowing that, hey, this process can go forward. I'm going to get a bigger check at closing. Oh, and I'm not going to worry about some email or phone call from an attorney from the buyer saying, hey, we got to talk. And so it works out very nicely, and it's an elegant solution for a risk that's out there.
So what is typically covered in these policies? What are the things that they primarily find that's wrong that would be covered a year or whatever out?
Yeah, for manufacturers in particular, the keys are going to be, first of all, reps about your financials. Okay. In most cases, most companies do not have audited financials. So you don't have that level of security that you had an audited statement and you know they're right. But if there are inaccuracies in the financial statements that could impact the EBITDA or the value of the company, that can have an impact. That is covered. Taxes, both state, local, federal taxes. If there are inaccuracies on the taxes and there's an audit that comes due post-closing, that would be protected. Not only defending an audit by the tax man, but if there are back taxes that are owed or penalties, those are protected. Any losses, and this is key with manufacturers, any losses involving a breach of material contracts, both customer contracts and supplier contracts, very important. And those could be devastating to a lot of companies if a key client is lost because the key client disappears suddenly post-closing. The policy will respond to things like that. where it's not going to be in, I would just say is this. If you got what we call valuation of assets, if you have huge multi-million dollar schedules of equipment or machinery, that's a little bit too big, or multi-million dollar levels of inventory, that could be problematic coverage wise. But in most cases, when you're talking about a purchase price under $30 million, those companies don't have huge schedules like that.
So what if does it give any protection if something happens like with the economy or with the supply chain or something that kind of throws the new owner for a loop, when they are buying the company, or is it just the discrepancies in the original agreement and the original economy that it was written in?
Yeah, that's a great question. What happens is, first of all, the scope of the coverage is black and white. It's essentially whatever the disclosures are that are in the four corners of the purchase agreement that the seller gives to the buyer, and it is outlined in the signed contract. That's all that's covered. Now, in the case we just had this situation with COVID, what if you go ahead and you put in all these representations about your company, and then they close the deal and a month later COVID happens? Okay.
Mm-hmm.
Now, some of the reps that you made pre-COVID may not be true. The policy would protect the seller and the buyer, because the buyer could collect on the claim. If something had happened that happened pre-COVID, it would step in. It would not happen if all of a sudden you've got a key customer and they had to close because of COVID. Okay. So business events that happen post-closing are not covered. But there were quite a few organizations that had their contracts, financials, everything that were true pre-COVID. You go post-COVID, and we had a number of sellers coming back saying, wait a minute, there are some problems here. The sellers were protected because of that policy. So what we do is we don't look for what's going to happen after closing. But what you do have in a lot of cases is some buyers are very frenetic. They maybe not do all their diligence. And then a month or two later, they may have a little bit of buyer's remorse. And they may come back to the seller and say, wait a minute, I didn't know about this. This policy will protect the seller, and sit down and respond to the buyer and work that out, because those are things that definitely can happen.
Okay. Can you share an example of where this happened, where reps and warranties insurance policy protected a seller in the manufacturing industry, so you can get a better idea of how that works in real life?
Oh, sure. So it was a material contract issue. And so we had I want to say like a metals fabrication company. They had 40% of their materials comes from one supplier. And they had a real favorable supplier rate, maybe 20% below market for the supplies they were getting, because they got great volume, and it was a good long-standing relationship. That relationship had been a 20-year relationship. And at some point, they had made an amendment to the contract that said, okay, in the event of a change in control where the manufacturer was going to change hands to somebody else, we, the supplier, reserved the right to renegotiate our agreement, maybe cut down that discount. Okay. That was missing in the paperwork. And again, it was a long-standing thing. And you could have situations like this where you got the paperwork and the agreements are there, and it's addendum number 15 of a 20-year long agreement, but it was missed. And so the deal closed, and literally less than 30 days, the new supplier got word of, oh, there's been now a change of ownership. We're resetting our pricing, which that's a big cost item, which impacted the value of the target company. And so all of a sudden, the buyer came back and said, wait a minute. And it was about an $8.5 million purchase company. But that change in price changed the value of the company by over $1 million. And so the buyer was, without the insurance, the buyer would have had to go to the seller and say, here is a breach of the contract. You never told us about this discount that they were going to withdraw. You should have told us about it. And it was just something that was missed. Okay. The
Mm-hmm.
nice thing is because you had an insurance policy there, the underwriter went over to the buyer and said, okay, show us the breach, show us the math. How are you coming up with $1 million loss? And the buyer said, well, look, we're buying this much volume. It's straight line. And this is what they want to do. Underwriter went, and this is the claims counsel that they brought, sat down with that supplier and said, you're not going to eliminate that 20% discount entirely. Maybe is there something we could do? All of a sudden, the discount went from 20% to 10%. Now, it's still that is a breach, but it was less. So now all of a sudden, the valuation of that loss wasn't $1 million, it was $500,000. Okay. The buyer was able to move forward with this updated agreement. That $500,000 in valuation was paid to the buyer by the insurance company, and the legal costs that the parties did, because you're not going to negotiate this without an attorney. You're using an attorney. Okay. The attorneys cost money. The policy paid the attorneys too. And it was great because this entire time, seller, clean exit. He didn't have to be involved whatsoever. There have been other cases with regulatory things where if there's a change in control, and this could happen with restaurants, but all of a sudden the health commission comes in and there may have been some old violations pre-closing, but they were so minor nobody cared. And then post-closing, oh, we're going to catch up on all of these things. Oh, and we have back fines and back delays and back penalties, which nobody knew of. Policy in that case stepped in and covered the buyer, which is great because the policyholder here is the seller. But by paying the buyer, A, we protect our policyholder, the seller. B, the buyer's made whole. And so it's a real nice piece because I'll tell you, when you're in the lower middle market, $100,000 or $200,000 claim is a big claim. And you want to be able to step in on things just like that. And that's the type of protection now we can provide for owners and founders.
So what's the process for obtaining a quote? You have so many things that are going on when you're trying to sell a business, when you're trying to wrap this into the manufacturing business sale. How does that work?
Process is actually pretty simple. You just need an application, just like a lot of other insurance policies, a fairly straightforward application asking about the type of business it is, where it's located, some features about it. Do you know of any past litigation, things like that. So fairly user-friendly application. Underwriters would then also need a copy of just the current balance sheet and income statement. If we have a copy of the letter of intent, the LOI, or the draft purchase agreement, either one, that's all we need. The underwriters take about a day to 2 days to look over everything and come up with pricing options. What a lot of us like doing now as you begin a process, and I don't know, if a owner or founder is talking to a buyer directly, like a strategic, or they're using an investment banker or a business broker, a lot of times the best process tactically to give you the most leverage is when you're in the LOI stage of the process, where you're just getting letters of intent from prospective buyers. You can put in a clause that says this indemnification provision here, we're not going to use that. We're going to use an insurance policy. Oh, and the parties will split the cost. That gives you great leverage because not only will the buyer now not have to hold back 10% of the purchase price. Okay, that gets addressed quickly. The buyer knows there's protection because there's an insurance policy. But the cost of the insurance, if you're the seller, hey, you can cut it in half. You just say the parties will split it. I can tell you, buyers will not have a problem with that, particularly because if you think about it, again, in the example where a $10 million deal is out there, if the buyer has no insurance, the most protection they're going to have is that 10%, $1 million withhold. Okay. But if the seller suggests, why don't we get a $3 or $4 million limit policy? Buyer looks at it, you can get more protection. I'll sign up for that. Sure. What's it cost?
Okay.
It being split is a great way to do it.
All right. Wow. Sounds like it. When it comes to, as we're getting to the end of our time together, if you had one best tip to somebody who is considering selling their business and going about that outside of just getting this policy, what is the best advice that you can give them that they need to consider and may not be thinking about with everything else?
Yeah, I'd say, okay, outside of the insurance, the number one advice I can give owners and founders is you need to select an attorney who specializes in mergers and acquisitions. Okay. Most of these companies have attorneys that have been helping them with their contracts, with their leases, with their documents, their LLC documents. Maybe even you've got attorneys helping with taxes. The skill set and knowledge that's required for mergers and acquisitions is one that's unique. And I can tell you it is worth every penny to utilize an attorney in the mergers and acquisition space. They are actually, I don't think there's a real material difference in cost between a general practice attorney and a specialist. But you get a specialist attorney and they are going to navigate you through the process. And again, they do as we do, is they're going to make it smoother, simpler, less stressful, happier. And that's really the way you'll want. And as you look at this, remember, you may think you have a straightforward business, okay? And you may think that your organization is very low risk, it's nice and tight and clean and perfect, okay? Little risk or low risk does not equal zero risk. There's always something out there. And so having that guidance from somebody that's outside of your sphere is, you can't put a price on it.
Okay, awesome. If people did want to continue the conversation with you, what's the best way to get a hold of you?
Yeah, the best way is probably through email. I'm on LinkedIn, Patrick Stroth, Stroth, but also just go to my email and ping me and I can respond immediately. It is my first initial P and then Stroth, Pete Stroth at libertycompany.com.
All right, awesome. Patrick, it was a pleasure having you on the show today. Thanks so much for joining me.
Well, I appreciate it. Thank you again, and I look forward to talking with you again.
Hey, sounds good. I'm Lisa Ryan, and this is the Manufacturers Network podcast. We'll see you next time. Thanks for listening to the Manufacturers Network podcast. Do me a favor and share this podcast with your friends and colleagues so we can grow this network and connect more fantastic folks just like you. You can either send your buddies to the website at manufacturers-network.com or share the Manufacturers Network podcast on your LinkedIn, Facebook, Twitter, Instagram, or wherever you and your industry friends hang out. The bigger and faster we grow the network, the stronger and deeper the community we'll all have. Thanks again, and I appreciate you.